Welcome back to another Tech Talk from MarketEdge.com, your source for unbiased technical analysis. Today, for our Tech Talk, instead of just recapping last week's market letter, which you can still find on our website, we're going to talk about the Momentum Index. This is a number that you'll see in that market letter, and we're going to discuss it with Mr. V, the founder of MarketEdge and perfecter of the Momentum Index. So, Mr. V, before we get started, let's take a step back. Tell me, how did you come to start MarketEdge?
I was a broker and I quit my job working for one of the wirehouses. I was a sales manager, quit my job, and a friend of mine had started up a small discount brokerage firm. And I told him what I wanted to do. And I said, come on, let's go. And we got going in 1990, I think it was. Put out the product maybe about a year later.
Very cool. So we have these incredibly impressive algorithms and calculations that are done automatically on every stock after the close of business each day. And one of the key factors in that is momentum. Can you tell us a little bit more about what momentum means in stocks? For me, I'm thinking momentum like when you're falling down a hill and all of a sudden you can't stop.
It's very similar. Getting into a good bear market, that's exactly what it's like. A big part of MarketEdge, we follow about 5,000 stocks, first of all, with long, neutral, and avoid computer-generated opinions. You're not going to get anything like this anywhere. But a big part of the whole thing, whether it's MarketEdge or just approaching the stock market, is you want to be on the right side of the market. Now, what that means is that when conditions are favorable, you want to be long stocks. When conditions aren't favorable, you want to be out of the market. Now, everybody will say you can't time the market, but we've been doing it since 1982. So what's that, 42 years? And we don't catch every wiggle, but we get the overall direction right about 75, 80% of the time. And it's not, a day-to-day thing. We typically, over a period of a year, will have three calls. Usually it's either bullish, bearish, and then bullish, or conversely, bearish, bullish, bearish. And we've been doing it, well, like I said, for about 40 some years. Now, how we do this is the trick. We can get into the market timing models we have, which there's three. One's based on cycles, one's based on sentiment, and the third, which you're asking about, is based on market momentum. Now, I think we want to talk about our momentum index. Is that correct?
Yeah, let's get into the momentum index.
Okay. Well, the first thing you got to do is you go, well, what is this and how do I find it? At the bottom of the page, we put out three publications. One's called the Daily Market Comment, which comes out daily. The second is our Market Letter Weekly, which comes out weekly. And third is On the Edge, which comes out every month. So the one you want to pay attention to the most is the Market Edge Weekly. So let's take a quick look. This comes out Friday after the close. And you'll see some commentary about the market, what it did the prior week, et cetera, et cetera. But the important thing is our three market timing models. And the first one is our cyclical trend index, CTI, which is the backbone of our whole market timing model. The second, which we're going to get into in a minute, is our momentum index. And then the third is our sentiment index. Now, what the momentum index does, and this is a takeaway from years and years and years ago, back in the late 1800s, early 1900s, when a guy named Charlie Dow and his buddy, who I think his name was Ed Jones, they developed the Dow Jones Industrial Average, which is still used today. It consists of 30 stocks, which gives, at a glance, a broad indicator, a broad look at how the economy, the U.S. economy, is doing. When they did this, now there's been changes in the 30 stocks over the years, obviously, but it's still the most quoted index in the world as far as stock markets go. And simultaneously, what they theorized was that the Dow Jones Industrial Average is making a new high or a new low. It needs to be what they call confirmed by a second index they invented, which is called the Dow Jones Transportation Average. And you can see these two on the screen right now, one right on top of the other. And their logic was that if the Dow Jones Industrial Average, DJIA, which is the 30 stocks, makes a new high, it needs to be confirmed by the Transportation Index, also making a new high. Otherwise, the move is what they call suspect. It's a non-confirmed high. Things are out of sync, and you shouldn't trust the new high by the Dow Jones Industrial Average. All right, well, come along back in the 70s. late 70s, a guy named Joe Granville expanded on this and said, well, it's not just those two. It's not just Dow theory that's important. The broader market, as measured by several other market indexes, also need to confirm new highs for them to be valid, or confirm new lows for them to be valid. So our momentum index is a takeoff of what Granville was talking about. And it consists of 10 market indexes, and they're listed right here under our momentum index. And there's actually quite a few more here. It's like 15, but only 9 of them are in the actual momentum index for the calculations. And what we list every Friday is the current reading where the Dow closed, prior week, and what we call our connotation. Now, the connotation is either positive, negative, or neutral. And if it's positive, that means that the index in question is performing in line or outperforming the Dow Jones Industrial Average since a previous low, let's say. We'll keep everything in this conversation on the bull side of the picture. And the bear side is just the complete opposite of the mirror. So if you look, you can see the transportation closed Friday at 15,730.52. It's actually negative when compared to its movement since the last bottom, which was back in April. The S&P is positive, the New York Composite is negative, the advanced decline line is still positive, etc., right down the line. So what happens is if it's positive, it gets a plus value. If it's negative, it gets a minus value. And if it's neutral, it gets a zero value. When you add all these up, what you end up with is the momentum index, which is, as of last Friday, remember this is updated every week, is +2, down from +4 the week before, and that gives it a neutral connotation. For it to be a positive connotation, it has to be +4 or higher. To be a negative connotation, it has to be -4 or lower. And those numbers are not arbitrary. What they're really telling you is that the majority, if it's +4 or higher, the majority of the indexes in the momentum index are positive. And if it's -4 or lower, the majority are negative. So now you have a setup. And this goes on every week. Now, so what, right? So what is, it's not always important, but at major turning points in the market, it's very important. For example, back in April, the Dow made a significant bump. Well, the momentum index was like +6, +7, very bullish. Why? Because while the Dow was actually getting hammered, the broader market indexes were doing a lot better. This is the situation you want for a bull market. Conversely, if the market tops out in here, if the Dow makes a new high, and the majority, keep that in mind, majority of these broader market indexes don't follow suit, you're going to get a negative momentum index, anywhere from -4, I've seen it down to -8, -9 sometimes. So that's why it's important, and that's why we put it together with our cycle model and our sentiment index, and that's how we come up with our market posture. Does that make any sense, Rachel?
I think so. So we don't really need to worry about what that +4 or -4 is. We can just look at the connotation, and that will tell us what we need to know.
We keep it as simple as possible. You're right. That's it. That's all you need to know.
Okay, awesome. So we've got positive and negative divergence. Divergence is when the overall trend is differing from the trend within those 30 stocks in the Dow Jones. Yeah?
Close. There's 2 words you need to understand. One, you'll hear that all the time, confirmed new Dow high. What that means is that the Dow made a new high, significant high. It doesn't have to be an all-time high or a year high. It's a new high off of the previous significant low. In this case, the low is in April. The new high is happening right now. So if the Dow makes a new high, and the majority of the indexes in the momentum index also are making a new high, then you have a confirmed move, which is very bullish. That's confirmation. If the Dow makes a new high and none of or most of the other broader market indexes don't, then you can have what's called divergence, which is also would be a non-confirmed Dow new high, and that would spell potential problems for the market going forward. Let me tell you a way to view this, Rachel. Tend to you're the 6 o'clock weatherman. This is always my favorite analogy. And because a lot of guys will say, oh, this technical analysis is a bunch of voodoo. It doesn't make any sense, et cetera, et cetera. The fact is, probably 80% of the people in the country tune in the weather, then pull up their favorite weatherman. And guess what he does? He pulls up a chart of the state or the area, and he starts to look at various conditions, various fronts that are moving in, different things that historically have affected the weather, and then he gives you a forecast. Technical analysis is the exact same thing. What's happening here with all this is identifying conditions and putting them together. And these conditions historically have had a terrific track record in forecasting future movement of the market.
Okay. So let's connect this to the real world. Let's say we have a subscriber who's just watched this video. When they log into MarketEdge tonight, what should they be looking for regarding momentum? And then how should they apply that to their decision making in trades moving forward?
Well, the first thing you're going to see is on the help page, if you come over to the right side, we have our market posture. And right now it's bullish, has been since August 22, so about 6-7 weeks ago. All right, when the Dow was up a couple thousand lower than it is now. And we also have our CTI, which is, again, the core, that's our cycle model, which is the backbone of our whole market timing model. Now, the second thing he wants to do, he goes, oh, okay, these guys are bullish. What's the story? They can come on down and check the daily and weekly market comment, which comes out around 6 o'clock. And it'll give you a brief idea of what the market did for the week. And then guess what's coming up? Here's breadth, which is the advanced decline line. That's one of the momentum indexes. And it tells you how that's doing. Has the VIX, which is another one. Declining volume, which is another one, et cetera, et cetera. It's breaking it down as to what's happening. And then it tells you where we are. It says, that we're still bullish and have been for 6-7 weeks as far as this goes. And so now he knows at least where MarketEdge is on the market. Now, if he wants to get a little more into it, they can go into our, what we call On the Edge, which comes out every month and gives you a much more detailed picture of the status of the market. This just came out a couple of days ago. And it gives you a chart of the Dow, and here we go. There's our cycle model. Tells you what's cooking. Our momentum index, something we've been talking about, I think, which is now neutral, and it's +2, as we said before. This shows you how the momentum index is calculated. You could see that off of the August 25 low through last Friday, the Dow's up 6%. And you can see the transports are up 4. The S&P is doing good. It's up 7. NYSE is the same. Russell 2000 way up. NASDAQ way up. Utilities lousy, and the advanced decline lousy. Ready? So when you mush all that together, what you get is a +2 on the momentum index. Then we have a couple charts. These are very important charts. This is the advanced decline line, one of our most reliable indicator. This tells you the number of stocks that are advancing versus the number declining on the New York Stock Exchange. So what you can see, remember I said when the market makes a new high, which the Dow's been making new highs, and the majority of the broader market indexes aren't, that's when you're going to get a negative momentum reading. And you can see the advanced decline line topped out a couple of weeks ago. It still might make a new high, but so far it doesn't look too good. Also, the number of new highs, very important. The number of daily, weekly new highs and new lows. The new highs you can see are blue. Again, you can see that hit a record high for this period 2-3 weeks ago and has been coming down. So when you look at that, and there's several other things that you need to get familiar with, we'll cover in a different segment, but when you look just at that, you can say, look, I think the market's losing its momentum. And guess what? It is. And when you go and look at our cycle model, which is, like I said, the backbone of our timing models, it's subjected to go negative here within about 2 weeks, I think, 2 or 3 weeks, which would coincide with the deterioration that's going on in the momentum. So that's what they should do. Now, that sounds like a lot of stuff. You could do all that in 5 minutes, as you know what's going on.
So you mentioned here the NYSE advanced decline line is a chart that we've got here in the On the Edge letter. Where else can they find that and other things to talk about momentum on MarketEdge?
Okay. again, this may sound confusing to you, and I can understand if you're new to MarketEdge, but there's nothing like a picture. And on our homepage, on the right-hand side, you scroll down a little bit, right above industry groups, there's something we call Market at a Glance. And if you click on that, you get a picture of everything I've been talking about. Okay, so here we go with the Dow 30. You can see that it was making new closing highs now the last 2 or 3 days. So now, is that a confirmed high or not? Well, let's go look. The NASDAQ composite looks like it also is making new highs, so that confirmed it. But remember, we have 9 different broader market indexes in there. In the momentum index, the S&P, looking good. So now we got 2. Now we come down to the Russell 2000. A lot more stocks than 30 Dows, a lot broader index. It's not making new highs, so it's not confirming the move. The transports, which go back to Dow theory, those guys must be having a heart attack if they look at this, because it's nowhere near making new highs. And you go on to utilities, the same deal. Now we come down to our advanced decline line, which is very important. And you can see what I showed you before. It's not making new highs. And you go over to the NASDAQ 80 line, also same boat. And here's our new highs and our new lows, a definite downtrend. So you look at this and you go, wait a minute. The guy on TV said the market's great, going up, going to the moon. But the reality is this is a non-confirmed move, because most of the major broader indexes aren't following suit. What does MarketEdge have? Well, the MarketEdge has a +2 on its momentum index. It was +4, and a couple of weeks prior to that, it was +6. This isn't good. Now, it's not a sell signal. It's not run for the hills, but it's telling you that the market isn't as solid as a lot of guys out there would have you believe. How's that?
Fair enough. All right, so I think that pretty much covers MarketEdge Momentum Index. Can you give me a quick summary, maybe 2 to 3 sentences tops, of what Momentum Index means to MarketEdge users and why they should pay attention to it?
They should pay attention to it because it really paints the real picture of what's going on. And if you understand that for a bull phase or a solid market to continue to go forward, it needs to be broad-based across all indexes and breadth indicators that we follow. So we won't change our opinion necessarily just because the momentum index is getting weaker, but we're cognizant of it. And when our CTI cycle model changes to bearish, it'll be definitely a confirmed sell signal if this deterioration keeps going on. So basically, if I'm an investor and I'm looking at the market today, I go, wait a minute, MarketEdge says it's bullish. The guy on TV says it's great. And I go, this momentum index is coming down. I'm not going to be as aggressive as I would if the momentum index was +6, +8, +10. That's what you need to know.
Okay, great. So let's ask our audience a couple of questions to see if they've really captured the lesson that we've taught here today. So question 1, what does a momentum index of +4 or higher indicate? All right, so question 2, explain a market scenario with confirmation.
Okay.
Question 3, check the latest weekly market letter. What's the current momentum index reading, and what does that suggest about market conditions? You can answer these questions in the comments below, or if you'd like some confirmation on your answers, feel free to email them to support@marketedge.com and we'll let you know. All right, Mr. B, is there anything else people should know about momentum today?
No, I think that pretty much covers it. You got to understand that the market's a very complex thing, and it's very hard to reduce an opinion on it down to 1 or 2 indicators. As you can see in our momentum index, we use 9 different broad-based market indicators to confirm a move. That's in conjunction with our sentiment index, which is similar, but it has about 12 or 13 sentiment indicators, whereby we're looking for a majority of those to be one way or the other. And then the backbone of the whole thing is our cycle model, which will give off about 3 or 4 signals a year as far as market fraction. So when you lump all this stuff together, you get pretty good results. If you just go on, hang your hat on one of them, I wouldn't trust it. But by the way we do it, you're pretty solid ground usually with what should be coming down the road.
All right, very good. So what I'm hearing is never create a strategy around a single indicator, but MarketEdge has simplified down several different indicators so that you can use a wide variety of indicators to create a strategy that will result in better, smarter trades.
Couldn't have said it better myself.
Great. Next time we chat, we'll cover the sentiment index and how MarketEdge users can make smarter trades using that tool.
All righty. I'll see you then.
Thank you very much.
Bye.
Bye.